Reduced volumes of imported steel, significantly increased steel prices, a growing risk of inflation. There are many factors at play in the US construction sector's steel supply chain right now. That's what we're here to discuss in the latest edition of Speaking of Steel. Welcome, guys. It's good to have you on our latest podcast. The team at MEPS. We've got here today US steel market analyst Laura Hodges. Hi, Laura. And in the studio with me today, we've got Gary Sanders, another member of the MEPS team. But we're really pleased today to be joined by Sarah Martin. She's Associate Director of Forecasts at the Dodge Construction Network. And she's here on hand to give us an overview of the US construction market. And it will really help us tie in with the MEPS research to understand some of the supporting factors of US steel prices in the months and into next year, in the months ahead and well into next year, I imagine, with Dodge's construction index giving us a little bit of insight in the period ahead. So, Sarah, thanks for joining us today. It's great that you can give us a bit of insight that goes beyond MEPS' usual research. I know Laura makes good use of Dodge's insight in her steel market reports. If we could just start off by gaining some insight on the macroeconomic factors that are expected to affect US construction in the months ahead, I think that would be really useful.
Yeah, sure. No problem. First off, great to be here. Thank you so much for having me. So from a broader sort of macro perspective, of course, we're seeing a bit of risk right now. Headline GDP came in around 2% growth last year, and we are forecasting 2.6% growth this year. But most of that growth is really going to come from, continued capital investment into, data centers and semiconductor chips, as well as a bit of fiscal stimulus from the tax provisions that were passed in the One Big Beautiful Bill Act. So GDP looks okay, but we're in this unique position right now where underneath that, right, there are plenty of warning signs that are certainly suggesting a lot of elevated risk in the economy. So, of course, one of the biggest challenges right now is the labor market. Demographics rapidly shifted last year alongside restrictive immigration policies, and that will continue to constrain the labor market in 26 and likely 27. We added less than 200,000 jobs last year. Construction only added around 14,000, which was its weakest performance going back to 2011. Construction jobs are, of course, a little bit more exposed to foreign-born labor. That's 25 to 30% of that workforce. And the overall aging workforce is also driving a steady stream of individuals to retire. And then you layer on top of that uncertainty around tariffs, energy prices, right? Things like the USMCA renegotiations, the change in the Fed chair in the midpoint of the year. And you can see why kind of confidence is pretty fragile, and uncertainty is just going to continue to be a theme in the near term. So our overall construction outlook has starts growing by about 2% this year. After, in real terms, right, if you strip out inflation, we saw construction starts decline by about 5%. So overall, a pretty, I would say, flat outlook.
Okay, and how far ahead does that take us, Sarah? And what's the full outlook that we've got there? What's the full picture?
Yeah, so digging into that construction outlook a bit more, with that backdrop, I would say, of weaker demographics, we're certainly going to see that playing into the housing market, right? That had a really weak year, primarily because of affordability, but longer term, right, as demographics remain weak, demand for housing will also remain pretty flat. And sectors like education, right? Education construction was really soft last year, given all the changes in federal policy. And again, projections around enrollments and demographics there. So this year is one, I think, where we are projecting about, a year of stabilizing in both of those markets. But I should have pointed out earlier too that we made those assumptions prior to the start of the conflict or the war in Iran, and so it's just adding a lot of risk that those could look a little bit more negative this year than we initially are projecting. Commercial construction, those are sectors that tend to be a little bit more sensitive to real-time economic changes like interest rates or changes in consumer spending. So, if households are facing higher costs and are worried about their jobs or a recession, then they're likely to spend less on travel. So that's going to weaken demand for hotel construction or spend less on retail goods, right? And that will correlate to weaker construction of stores or warehouses, e-commerce related warehouses. So, a mildly positive year projected, but again, one that is fraught, I think, with risk, especially as the consumer continues to face a lot of risk. On the plus side, we have demand for healthcare has been really strong in recent years. A lot of demand coming from the baby boomer generation. Lots of growth in the average cost per square foot of hospitals, just really expensive hospitals. So that's just causing the dollar value to be quite strong in terms of our forecast. And then, of course, data centers and energy related construction are lots of, they had a great year last year and we're likely to see pretty strong demand going into this year. But overall, points to a rather narrow picture of what's keeping construction kind of afloat in the near term.
You've touched on some of the sectors there. Are there any particular regions of the US where the recovery or any hoped for recovery might be stronger?
Yeah, that's a great question. So in aggregate, right, as we move beyond 26, we're still forecasting, pretty flat growth in 27. But in aggregate, we expect kind of the industry to begin to re-expand a little bit more substantially once we reach 2028. But when you dig into those numbers in 2027, we're seeing the turn kind of start, that recovery begin, likely in the US South, a little bit in the US North Central as well. So strong data construction in the North Central regions kind of propping up those numbers. And then the South, has had a tough year last year from a construction standpoint. But it's the largest region in the US. As things stabilize, of course, it will continue to benefit from stronger demographic trends, right? And so that will help major things like commercial and education construction do a little bit better. But there's also just a lot of other sectors that are doing quite well in that region, right? Or will be by that point. So, manufacturing, petrochemical refineries, data centers. We know Texas is a growing hub for that, for data centers in particular. So I think the sort of diversity of all the different sectors allows that region to kind of turn first and have it be a little bit more resilient and drive that recovery.
Okay, well, you've touched on quite a few of the risks and opportunities already, Sarah. But if you could just perhaps summarise some of the areas really where there are perhaps opportunities and also risks that steel demand in construction might go one way or the other. What are the key influences there?
Yeah, so of course, yes, there's a lot of risk right now in the macroeconomy, in the construction sector in particular. The labor market, higher material costs, those are the big hurdles that we've been facing in construction for a long time now. But that doesn't mean that there aren't pockets of opportunity, right? So as I've mentioned, data centers and power generation, healthcare, those are certainly like the clear bright spots in our outlook. But even in a sector like hotels, right, where activity has been quite weak, if you dig into it a little bit, you can see that, a subsector like luxury hotels, demand there has remained pretty strong, or is, not weakening like the other sectors, thanks to kind of, the K-shaped economy that we're in. I'm sure you've heard us economists sort of use this term before, but, it's the notion that the top 10 to 20% of consumers are spending more right now, while the bottom 80% are spending less. So certainly a very concerning dynamic that's worsening in our economy, and I think does add risk. But, it allows us to, in terms of which types of construction is moving forward, you can see that, those luxury retail stores or hotels are the things that are doing, remaining a little bit more resilient. So all that to say is, this is really on the margins though, right? The big hurdles of labor and material costs are, along with everything else, I think are going to be the big thing that, of course, will largely put a ceiling on how much construction can take place in 2026.
Okay, so I mean, I think we've heard a lot of the things that would be echoed within MEPS recent steel market reviews. The International Steel Review that we currently produce features US commentary. So I think we'll reflect with Laura and Gary on some of that steel price nuance that we've been keeping track of. I'm sure we'll pull you back into the conversation, Sarah. Thanks ever so much for that summary. Really insightful. So, Gary, I guess if I could start with you, I mean, you really speaking to customers in the market, traders in the market, and steel buyers who have seen those rebar and beam prices increasing in recent months, in particular particularly since the Section 232 regulations came into play. What are those respondents saying about demand generally from construction?
Thanks, Tom. Good question. And it's all across the board. And depending on the segment of the construction market, the particular MEPS research partner is actually focusing on. And so we get mixed messages. Those that are engaged in the large projects that Sarah mentioned say they're extremely busy. Their year is all but sold out. But then you talk to other respondents that we have, and they may be catering more to the residential side of the market, or what I call the light commercial, which is in direct downstream from residential construction, whether it's strip malls, Dunkin' Donuts, etc. And they would say they're not very optimistic in regard to the future for 2026. And again, it's tied to what are they tied to, and the residential not being that strong this year. But in general, long products, wire rod has been very busy. Short on supply, considering the amount of consumption we have in the U.S. Beams, extremely high demand. Believe they're sold out through the middle of the summer currently. Again, very high demand tied to data centers. Rebar has had a recent uptick in import supply into the ports in the U.S., which has eased some of the strain of shortage of supply from fourth quarter of last year. And then MBQ, which can be from manufacturing to commercial construction, residential construction, and that seems to be holding its own with, similar to what Sarah mentions, with sideways demand for 2026.
Yeah, it's quite a complex picture, and I guess it depends on the size of those suppliers, and also, are they in the contract market, are they in the spot market? It's quite complex.
It is.
But there is surely, it sounds like there is demand from those sectors that we heard Sarah talking about there, that particularly we hear data centers cropping up all the time, don't we? Laura, you're clearly writing a lot of the text in the ISR's US section and gathering a lot of information. Can you reflect perhaps as well on those factors, the demand that you're hearing from respondents and writing about regularly?
Yeah, thank you. And good to be here again on this podcast.
It's good to see you. Two months, two consecutive
2 months in a row, but different location this time. What I hear is that demand overall is fairly steady. I wouldn't say it would be exploding for many that I speak to, or contracting necessarily, but the theme that I'm picking up on, which may be no surprise to you since I often think about the outlook, is they question whether this rally or these increased prices can be sustained because of many of the factors that Sarah just went over. And of course, the mounting kind of risk that, not just the U.S. economy, but of course, the construction industry itself has weighing on it. I mean, one thing we didn't necessarily, bring up is, even just the Section 232 tariffs, as remained intact. But, there's other tariff programs that are uncertain. And there's so many uncertainties floating out there, including now the impact of higher energy prices, freight costs from the Middle East conflict, the Iran war. And this uncertainty, I mean, out of any industry, uncertainty can really halt, investment decisions. So it can weigh heavily on those. So I think that's really the main thing that I'm picking up on is really just, where is this going to go for the rest of 2026?
I know the last time you were sat here with us, Laura, we were talking about in particular the effect of tariffs. Could you just quickly reflect on how Section 232 has affected supply into the construction sector? Well, I guess into all sectors, but construction primarily, since they were introduced on a blanket basis early next year and then ramped up to 50% subsequently in the summer.
Great question. And one that I love to discuss. So, imports on the steel side have certainly been reduced because of the now 50% Section 232 tariffs on steel and aluminum. But I will tell you that this has been more of an impact on the flat side of the market. So think of coil versus the long side, which is what we're talking about here, the long products such as rebar, wire rod beams, merchant bar, construction steel in general. And I do think that this reflects more of the limited domestic production that is here in the United States. Right now, like just as we speak, we're bringing in per month around 350 tons of construction steel a month into the United States. And we're talking carbon only, not necessarily anything to do with stainless, but on the carbon side, construction steel, 350,000 tons a month. And that's about 10% lower than the monthly average in 2024. So before all, really the reinstatement of the Section 232 tariffs. We did take a little bit of a dip in the second half of last year, but Gary just kind of alluded to some of this. We have been trending higher, and specifically, Gary mentioned the rebar increase. That increase over the last few months in rebar imports was a contributing factor to a $20 decline per short ton of rebar prices last month. So I guess the other thing to really highlight is the change in this reduction in supply has also brought a change in the trading partners. Who is bringing in the steel into the United States has really changed dramatically over this last year, with South Korea now being our largest trading partner for long products or construction steel. Some of this change was due to a rebar trade case initiated last year against 4 major importers. Let me see if I can get Algeria, Bulgaria, Egypt, and Vietnam. Gary, correct me if I'm wrong. But those have, we basically eliminated imports from those countries given the anti-dumping and countervailing duties that are now imposed on them. But for the most part, we had to change the distribution of importers, but really the emergence of South Korea, I think, has been particularly interesting.
Yeah, it's fascinating to see the effect of those tariffs. Just wanted to come back to you, Sarah, briefly. I guess, as we've already alluded to, the cost of construction materials must have a huge bearing on investment decisions, as does inflation and interest rates. Is that some of the insight that the Dodge Construction Network look at, and something that you're aware of, that these soaring steel prices that we've recorded at MEPS are really perhaps feeding into a bit of a slowdown or some apprehension about those large projects?
Yeah, certainly. I mean, we've seen certainly our producer price indices that we track at Dodge showed, 4 to 5 to 6% growth last year. A lot of what we're still trying to get a handle on is how much of that price growth has already been passed on to consumers, or how much still has yet to be sort of passed on. And so it seems like most businesses were able to to not pass on the full cost last year, but this year they will. So we'll continue to kind of see those price increases eventually reach our sort of final demand, sort of CPI or PCE series this year. And when we look at things like the average time or the median number of months it's taking for projects to move from planning to groundbreaking, last year we saw a big uptick across several sectors like manufacturing and warehouses in particular. It just slowed down a lot in 2025, and it's been slowing down since the pandemic. And a lot of that is driven by the labor shortages, and of course the material costs as well, right? That's limiting the speed at which projects are moving, and increasing the chance that they get delayed or canceled overall. And then, of course, just the uncertainty of last year, the uncertainty of the tariffs and the costs is a big question mark that makes a lot of, as Laura stated, owners and developers sort of be on pause, stand still, and kind of wait for that uncertainty to pass.
Something that will keep flagging up in those risks, I'm sure. Thanks, Sarah. Gary, just feeding into this supply issue is, as we've reported in the International Steel Review a few times, there's quite a lot of domestic capacity coming online this year. Could you tell us a little bit about that and how that might affect the supply situation in the US?
Yeah, thanks, Tom. Two sides to that. Again, we mentioned the import and specific to rebar and to wire rod that is increasing in this first quarter of 2026. In addition to that, the domestic mills have increased their capacity of approximately 1.5 million tons on an annualized basis for rebar production. And that's going to ease a lot of this constraint that we saw in the fourth quarter of 2025, where we saw multiple price increases. And again, Laura mentioned that we actually saw a price decrease, unofficial, but the prices negotiated, transactional prices, did weaken in the last 30 days. And again, that's due to the import and due to the increase in capacity from the domestic mills.
So is that something that you'd expect to continue? I guess that material is now coming into the market, isn't it?
It is, and bear in mind that we're just starting, second quarter when the majority of the country really starts to get its pace in regards to construction season in the U.S. So I believe that a lot of that additional capacity will be absorbed, and bear in mind, whilst we are talking about an increase in imports in the first quarter, on the whole, annualized, we will be down on imported steel into the U.S., and it's where that domestic additional capacity will make up for that. I still believe that with all the projects that are out there, additional capacity, it feeds into what Sarah was mentioning is basically a sideways market for 2026 and prior to the conflict in the Middle East. So we feel that sideways is a good thing, really, considering all that's taken place in the last, 12 months.
It brings a little stability.
Yes, stability is critical to those in business, and as Sarah mentions, in regard to new projects and somebody that has to invest, stability brings some confidence.
Yeah. And Laura, you've been tracking that capacity that's coming online. What are we expecting? What have we already got online? Is there more to come?
Yeah, in terms of long products or construction steel, I mean, the thing to keep in mind is that this new capacity will not benefit everyone. It is highly concentrated in rebar. And some of the tighter markets, as Gary mentioned earlier, are things like beam structurals, that side of things. And one that we even had issues with prior to the 232 tariffs been reinstated is wire rod as well. So there, most of the new capacity that really just started to come online. So this is going to be a gradual increase over the next, year or two. But the total new capacity of rebar between CMC, Nucor, and High Bar, which is a new producer in Arkansas, is around 1.5 million in capacity. So we're not saying that 1.5 will be introduced to the market this year, but that is what at least the new capacity that came online last year and slowly kind of ramping up over the next year or two.
Okay, so yeah, quite a significant number, and particularly rebar. So that's an interesting one to watch, isn't it?
Yeah, and I'll just add that, to put it into context, the typical average year for rebar consumption in the U.S. is 10 million tons. And typically 20%, whether we're in a down year or a good year, is typically import. We're currently averaging around 10%. And again, it goes back to the question around tariffs and uncertainty. So this additional capacity is whilst we're nowhere near that 1.5 million, the mills are still getting themselves up to speed, it's going to help with that shortfall of import.
It's certainly got a feel of reshoring about it, hasn't it? You know, there are people clearly are going to be celebrating that uptick in demand from domestic producers and in prices. So, you know, there are positivity in quite a few quarters, I guess, at the moment.
Yeah, the steel mills are very profitable right now.
Yeah, absolutely. Let's hope the construction sector can achieve
Absolutely.
some of that as well. On the, you know, on the contrary. Laura, you know, I'm keen to speak about our outlook at MEPS for prices. I'm aware that, you know, we've already mentioned quite a few risks. We've touched briefly on the Middle East conflict, which is, you know, it seems quite unpredictable at the moment in terms of its duration and its effect. But could you just give us perhaps a little overview of MEPS assumptions for the months ahead?
Absolutely. And before I do that, given that we are a price analytics firm here for steel, I just thought I'd do a real quick run through of where prices are right now and then lead into the future. So for U.S. prices of construction steel overall, you know, your wire rod, rebar, beams, etc., those are up about at least 20% since January of last year. Beams prices are up 34%, just to call them out. We do like to talk about beams here, and are now at record high levels, given, you know, our price history here at MEPS. And rebar is the only product to drop in price over the last, 15 months since the beginning of last year. So just a couple of things to keep in mind as we go through the outlook. And I guess that the major point I want to make too is that steel prices in the US are absolutely the highest in the world. You know, so we were high, and now because of the tariffs, we've gotten even higher. So that's going to kind of play a theme into the outlook. So with regards to the outlook, we were expecting prices to fall back modestly in the second quarter of this year. But due to the Iran war and some of the factors that we're hearing about in terms of higher cost, I do think that is going to delay. Our latest outlook having that decline, that soft decline, is going to be delayed until the summer at this point. This is our latest outlook, and that's really due again to the higher freight and other costs that we're anticipating could impact even the import equation, you know, whether to import or not, and just a general uncertainty that kind of pushes that delay out a bit. So the reasons for this pullback, again, high prices. High prices in the U.S. are, as we even noted earlier, starting to attract imports, and assuming that they stay high, that will continue to attract imports despite the 50% tariff. Supply chains also needed time to adjust. I mean, we've had a major disruption in the U.S. supply chain for steel. I mean, you get imports, there's a couple of new suppliers. We needed time to adjust, who bought from where and when. So those supply chains needed to adjust, and I think we're getting to that point. And then really coming back to the real reason of this webcast on the demand side, without the support of true demand, i.e. the overall construction sector, not just tying it to, the tremendous growth we've seen in data centers and even some major infrastructure projects, we really do need the support of that true demand for prices to remain at the levels that they're at and even increase further. So, because of that lack, as Sarah mentioned earlier on, just the overall market this year in 2026, we do think that prices, for that reason, will also, put some downward pressure. But to put it in perspective, I'm taking rebar, Gary's favorite subject to talk about. Rebar in perspective, we're talking about a 5% decline. I referenced over 20% since January. We're talking about a 5% decline in prices is what we're currently forecasting. And Another favorite topic of mine to really talk about is, of course, this narrow range that prices really have to move right now. You got the tariffs on the low end, sort of raising the price floor for prices here in the United States, and then you have imports coming in and capping or creating a ceiling. So we do have a more narrow range that we feel is assuming that 232 tariffs stay at 50% across all countries. I mean, as Sarah noted, where there's a USMCA discussion coming up in this summer. But assuming that stays in place, there is going to be a more narrow range than what we're used to dealing with for steel prices in the United States. So with that in mind, slight decline coming this summer that we're anticipating for some of the reasons I highlighted earlier. But keep in mind, there's a whole lot of risks to that outlook, and one that we will be monitoring quite closely and continuing to update every month when we look at our outlook for steel prices here at MEPS.
Absolutely. Something I don't envy Sarah, actually. You're always looking forward, Sarah, and looking at those risks. At least at MEPS, a lot of our research is to do with the current market and the current market prices. I think you've got your work cut out in the months ahead, haven't you?
Yes, definitely. Yeah.
Listen, well, thanks ever so much for joining us. We're going to wrap up there. But as we always say, people should keep in touch with MEPS and subscribe to the International Steel Review to keep up with regular steel price updates and regularly updated forecasts. With so many risks at play, it's really worth keeping an eye on those. So little more ado. I'll just thank Gary for joining me. Great to see you. Your podcast debut. You relaxed? It went well?
Yeah, feel good. Thank you. Thanks for having me.
And Laura, great to have you back in the studio, albeit from afar. Thanks for your input.
Thank you.
And Sarah, hopefully we can welcome you back at some point. It's been really good working with you, and thanks ever so much for the overview that you gave us at the start of the podcast. That was great.
Yeah, definitely. Thanks so much for having me.
Lovely. We'll leave it there for now, but keep in touch and make sure that you tune in for further episodes of Speaking of Steel.